Welcome to High on Utah. This is Heather Groom, and I'm here with John Creager, one of my favorite loan officers, and I work with him often in the real estate industry. So we've also named the podcast High on Utah. It's a little play. People have asked where it came from, and I used to really like John Denver. And my son, when he was a newborn, he would only fall asleep to John Denver.
Okay.
And so it's just kind of a funny thing. And
Yeah.
so we always talked about Rocky Mountain High.
Love it.
So anyway, we're in Rocky Mountain High
play.
territory
We
right
are,
here.
absolutely.
So welcome, John.
Well, thank you for having me. I appreciate it. Congratulations on the new podcast.
Oh, thank you.
I know people have been asking you to do this forever because you do have so much industry knowledge and insight to share. And I think this is such a great way to get out and convey that to everybody.
Oh, I love it. Well, it's definitely a little bit out of my element, but I'm loving it. And I really like the feedback. In fact, I love your questions too and suggestions. So this is going to be fun. I get a lot of questions often about lenders, about mortgages. And right now, especially in the last few years, we've had kind of some ups and downs, some crazy things happen, just very unique in the industry when you look at the industry overall and what's happened. And so I thought today I'm going to, ask you some questions and then also jump in and tell me what other questions we should be asking you.
For sure. Absolutely.
But first of all, tell us a little bit about you and kind of why you decided to get into the mortgage industry.
Yeah, I love it. So my background is in finance. I've done finance my entire career. And I've helped people did initially auto finance, got a degree in finance, those kind of things. And the more I saw that wealth could be built through financial means. So doing like auto finance, for example, fantastic, all right, but you're buying something that's depreciating. And so it's a little trickier to make financial sense of it, right? But the more I was around real estate and saw how much wealth could be built through real estate, I thought, I would love to be a part of that personally, right? To better understand it, but then also to help people along the way. So more than anything, I saw a way to improve my career and kind of build out my network, but also help people build out their network and their financial stability, I guess, at the end of the day. I loved it.
I love that. Okay, so and it also I like that you're talking about depreciating assets and appreciating. Yes,
it's a big difference, huge difference.
Huge difference. Yes, because I will have once in a while somebody ask me and they'll say, "Oh, but a car appreciates or it's not. I won't lose money." And I'm like, "Really? Are you sure?
Yeah,
sure?" I don't know.
Very rare when that happens.
Yes, very rare. So anyway, well that's interesting. So tell us a little bit like how long maybe you've been in the industry and then. And maybe do you have like a team that you work with then?
Absolutely. So I've done finance my whole career. Okay. I've been in mortgages for 3.5 years now, kind of switched right after the refi boom, actually, when a lot of people told us not to switch as lenders because the really good days had ended. But the cool thing was it forced me and my team to learn through the hard times, right? I mean, let me give you a little bit of
I love that.
Well, thank you. Yeah. Let me give you a little perspective, right? So if you go back to 2000s, even 2010s, that kind of thing, mortgage lenders would get once a month a repricing alert. So you'd call me and ask what the rate was, and I'd look at my rate sheet and I'd tell you, and then maybe a month later, you'd call me and it would be different, right? But relatively stable over that time. Since I switched, not actually the day I switched, but basically since I switched, we have averaged somewhere of 2 to 5 reprices a week. Let alone we've had 4 to 5 in days. So in the last week, we've had days where mortgages repriced 4 or 5 times.
Wow.
And historically, they would take 6 months to reprice 4 or 5 times, right? And it really has just been this trial by fire experience. But I think the fantastic thing is it's taught really good behaviors to anybody who's been in the industry and really helped us to understand what's important to people, right? We have to focus on the fundamentals rather than just kind of grabbing the easy deals, which was great for a while, right?
Yes.
So it is me, it is my business partner, and then we have a team of about 5 people underneath us that work for us. We really try to be hyper efficient and kind of like you have low touch points.
Right.
I think when people buy real estate, it's so complicated. There's so many pieces anyways.
Oh, absolutely.
Let's just limit the number of people they have to talk to. So we really strive to do that.
And I love that. And you've been great to work with because one of the reasons I'm having John on because we've had some interesting loans together.
Some interesting experiences, yes.
And he's got great programs as well. So even a lot of people, which we'll get to, but there's different programs out there and even for medical professionals, different industries, sometimes the homeowners, kind of the first time buyer grant, things like that. So, but I've had an experience where I couldn't get it through another lender and I'm calling John because I know if anyone can do it, I'm going to give this to John. And he did. He actually got it across the finish line, which was great.
And I want your clients to know that that alone is a great reason to work with you independent of all your other skills, right? financing is such a big piece of buying a home. It really is. Even if you just want to look at the
Yes.
math, it costs as much to finance a house long term as the house costs, right? So if
Right.
you don't take care of yourself on the financing side, it really doesn't matter what you paid for the house. So the fact that you have that insight to share with your clients, yeah, maybe you can save them this money off the price of the home, but maybe you can also save them like 100,000 in interest over a loan or 200,000. That is massive.
That
So
is.
yeah,
It's
kudos to you.
huge. Oh, well,
Yeah.
thank you. Well, good. Well, I just wanted to dive in, and I
Mhm.
have to use my cool little reading glasses here at some point.
And they're
I printed off some of the questions that I get often,
yeah,
and I just want to kind of understand, like, so first of all, right now I've got a lot of first time home buyers that have
absolutely.
been
Hmm.
kind of waiting on the sidelines. They've been waiting for interest rates to drop, and we have all these little clever phrases, right?
Yes. Hmm.
Like marry the home, date the rate. I
Hmm.
mean, we have all these little clever things we say, and because rates do change,
They
and
do.
like you're saying, and that's a good reminder for me because I do remember the days when, the updates were not very often. I
Yeah.
mean, it was like, oh, are we going to get an update on rates? And so I do remember those days. And
Hmm.
now it's like everybody's even looking at their daily updates.
Yeah.
They're like everyday checking rates,
Absolutely.
and that's
Absolutely.
what I do. I
Yeah.
mean, it's really cool. I wake up in the morning, I'm like, oh, do I have a rate update yet? So that's kind of
You
what
sound
I do.
thrilling. All right.
Yeah, I know.
So
It's
yeah.
super exciting, but it impacts these first-time home
It
buyers
does.
especially
Yeah.
so much. And even my investors,
Mhm.
for first, I call them first-time investors also because there's, people get a little nervous to buy a second home or an
Yeah.
investment
For sure.
property. And so a lot of people have been kind of waiting on the sidelines. And I've been explaining to people that actually right now is great because your purchase price is a little bit lower.
Yeah.
And yes, your rate is not going to be, at the 2.75 days are
Nope.
gone. In
Yeah.
fact, I'm going to put up a little picture at some point.
Hmm.
But last year at Halloween, I have to just give this little tangent. But
I
for
love
my
this.
work party,
Yep.
for
It's a
my
great
work
story.
party,
Hmm.
I like had a skeleton that I dragged in, and people didn't understand it at first. But it just had RIP, like rest in peace, and it had like this little tombstone. It said 2.75,
Yes.
and it was like this skeleton, and I was dragging it in back of me, and I had a little number 8 balloon, and I was
Mhm.
like, 8 is great, isn't
Uh-huh.
it? And people were like, what's 2.75, and why is it dead? I'm like, because that interest rate is long
It ain't never
gone,
coming back.
and if
Yeah.
it comes back, it's gonna be like there's gonna be movies about it,
Yes, and we will be in trouble again. Okay. All
and
right.
it might get
Yes.
us in a little place because it did start to get a little bit
Oh, for sure.
a
Yeah.
little crazy because I was actually what most people don't know is I was actually in mortgage origination
Mhm.
for a
Yeah.
little
I
while.
remember you telling me that. Yeah.
And
Uh-huh.
like years ago, like 20 years, when
What'd you do when you were like
refinancing.
10 years old then or something like
Yeah, it
that?
was something
Okay.
like
Yeah.
that. Yes,
Okay.
yes. And it was really interesting. And I actually kind of saw how the market
Mhm.
was changing, and that there were different things happening. And people were like, "Oh, I just want to use my dad's social security
Mhm.
number on my
Yeah.
loan
Mhm.
application." And I was like, yeah, that's not legal.
Yeah. Uh-huh. Yeah.
So then I actually was like, this is getting a little too crazy, and I stepped back.
Yeah.
And then
You saw
we
the
had
writing
the
on the
meltdown.
walls. Yeah.
I saw the
Mhm.
writing on the wall, and I
Yeah.
basically just said, hey, I don't want any part of that. I was only doing ethical loans,
Yes,
okay?
for sure.
So for the record,
Mhm.
but a lot has changed
Yeah.
and evolved. And right now, I think we've got a lot of first time home buyers or first time investors,
Yeah.
even that are, nervous to jump in. And so I thought, let's start with some of the even basic
For
questions.
sure.
Like,
Yeah.
what's the difference between people always ask and they say, what's the difference between getting pre qualified and a pre approval?
Yeah, absolutely. Before I do that, let me even go back to one thing that
Yeah,
you brought up. And you brought it
absolutely.
up twice, okay? You brought up the word nervous, right? And I
Yes.
think nervous is such an appropriate word for the last few
Hmm.
years, right? And I get clients, you get clients all the time, and whether they say it explicitly or not, they're nervous, right? And I
Absolutely.
think the biggest thing I'd want to convey to people right now is like, yeah, you should be nervous, right? Like there's so much movement constantly, all right? So like in the last 4 months, we went from calls for the Federal Reserve to do an emergency rate cut because they thought the sky was falling and the economy was
Yes.
imploding, to now all of a sudden where we've scaled back the expectations for the federal rate cuts. So we are filming this on what is it, November 7th, 2024. There was a Federal Reserve meeting today.
We're
Three
barely
months,
going to
yeah,
miss
we're gonna
it.
miss it by an hour, okay? 3 months ago, there was conversation that this meeting they were going to cut 100
Yes.
basis points off the rates.
Yes.
And now today we're only cutting 25 likely, and then probably next meeting we might not cut anything. So anyways, you want to talk about nervous? Great word, right? Because like none of us can predict
Hmm.
this. And I think more than anything, the topics you're bringing up are topics that are hopefully more timeless, right? Because the market
Yes.
does just go like this.
Right.
So to come back to your question, pre-qual,
Yes.
pre-approval. This is a timeless thing. Doesn't matter what rates are, doesn't matter if they're 2%, 8%.
Absolutely.
This matters, okay? So here's how I look at it. And once again, I can only speak for myself, but there are tons of incredible lenders out there, and I know most of them, and they do follow a similar path. So a pre-qual is where we'll hop on a phone call with the client and get a basic application, okay? We're gonna ask for name, date of birth, social security number. It has to be yours, can't be your dad's, by the way.
Yeah,
Okay,
yeah.
all right?
Good thing, by the way.
Income, assets, all of that, all right? And what we're looking for at this point is, I like to say, just red flags. I'm really trying to be like, okay, do you make enough money? Is your credit score high enough? We're trying to get a general, all right?
Yes.
So with that, hopefully at the end of that call, I can give you a general idea of whether you qualify for or not
Right.
really. And I like to do this for your sake as the agent and the
Yes.
buyer, because this sounds so bad, but the last thing I want them to do is go emotionally fall in love with a home that they're not even close to being able to buy. Right?
Agreed.
And
Yes.
like use your and their time, right? So that is a pre-qualification, okay? Now, if at that point they're like, okay, I kind of like the answer, I think we want to do this, we move to the pre-approval stage. And the pre-approval stage is where I get documentation to support that. Now, we have some awesome new systems where we can do a lot of that electronically behind the scenes, so you don't even have to provide it. But sometimes you do. So then we'll get pay stubs, we'll get your W-2s, we'll get your tax returns, those kind of things. And we put all that in, have it looked at, and then give you an actual pre-approval letter. Okay, so a pre-approval letter is me as a lender saying to you, agent, client, and then seller, that this person can likely take out a loan and qualify to buy this home. All right. But there's a little misnomer in this industry. That's not the end. All right. So we also offer a tier called a credit pre-approval.
Yes.
All right. This is awesome, especially in the volatile market we're in right now. And especially if the market gets volatile in a good way where you have to go compete again, what we'll do is we'll put you into underwriting in advance. So basically, we'll just put in a TBD address, just pretending like you're basically buying this house, and go all the way through underwriting to look for any major holes in the file. Then you get a credit pre-approval at that point, which actually comes with a guarantee that protects your earnest money, protects your appraisal costs, and then also gives you a guaranteed closing timeline, assuming everything looks worth out. And that's kind of the highest level of pre-approval that you can get to. And then you can go shop with less nerves, I guess.
Yeah, no, and I love that you went into that detail
Yeah.
because I've had that situation, especially with people that are self-employed,
Yeah,
for
huge.
example, like because banks, I always joke around and say banks love it if you're employed at a 40-hour
They do.
week job. You know,
Same.
it's very clear cut, not based on commission,
Yeah.
you know, salaried. But a lot of times if you own a company, there's just a lot more that goes into it. And
Absolutely.
so like for some of those clients of mine, I will actually say, hey, John, can you run this by underwriting, you know, kind of run it through, because then you are protecting your client, their earnest money, like you said. And there's nothing worse than, and truthfully, I've never had it actually really happen because
Amazing.
I'm very careful. I think because I was in loans. So
Got a little
I did enough.
PTSD.
I joke
Yeah.
around and say I'm enough to be dangerous to
Yes.
myself and others, right? But because of that, I am very particular because I never want to show clients homes that they really are not going to qualify for.
Yeah.
And so so a lot of times I'll ask for that, especially if I can kind of sense that there's some complicating factors.
Yeah.
And so I love that you went into that detail. So that's really great. What has changed for investors even in the last little while?
Yeah, so I would say, let's go back to the 2008 type period, right? Where anybody and everybody could be an investor, right? And then ultimately that kind of led to the whole thing crashing down, right? So there was definitely kind of this lockdown on investors, right? And what's happened over time is interest rates have gone up on investors. So during COVID, when everything went crazy, the feds came in and they raised what's called, this is technical details, a loan level pricing adjustment, which changes rates basically. So investors end up paying more for interest rates. And the reason was they wanted people actually buying homes to get into homes.
Absolutely.
And I think that's our prerogative too, right? Like,
yes.
We've both been very blessed in owning real estate, but ultimately I think we love seeing people own their own homes, right?
Absolutely.
So investors, rates have gone up. It's part of life, all right? It's part of
And I don't see it going down.
No.
I mean, kind of to jump in, and I was telling my investors this, it was interesting because when the market was just starting to surge, a few years ago, I think that's actually kind of, we all have little superpowers. And that's one of my superpowers is usually I can kind of sense it.
Love that.
And because I work in also the Wasatch Front market, Salt Lake, but then also down south in St. George. And I could just see this kind of surge happening. And I was like, it's kind of like you're looking at everything and you're going, okay, the loan price, is so
So
low
low.
that I was like calling my investors and I'm like, If you don't get on an investment property, and specifically like even in this kind of these Airbnb
Yeah, the
pockets or
second
like,
homes, that
yeah,
kind of stuff.
second
Yeah.
homes, short-term rental
Yeah.
market, I was like, we're going to run out of inventory, which by the way, we did.
Yeah.
But I would put them on new build contracts that locked in their pricing. And that's why one of my builders is like, we love you. And we're also like, you're our worst nightmare.
We hate you, all
Because,
right?
yeah, because
Yes.
they're like, we
So
also know that you get your best pricing for your clients. And so what happened is my clients locked in the pricing. Some of them closed with a few $100,000 in equity off of a
crazy. Yeah,
$500,000 build.
nuts. Yeah,
Like
just nuts.
crazy
Yeah.
stuff. And they were very thankful. It was
Yeah.
a really interesting time. Probably one that I won't
Unsustainable.
see it unsustainable.
Yes, okay.
And I want to be
But
clear
great
because
time. Yeah.
as much as even during that 2.75 time, there were times where I was like getting nervous because I was like,
for sure.
I
Yeah.
don't want a repeat of 2007.
Yes,
I
this thing's
don't.
going up, and then it's got to
Yeah,
come down at some point.
I was like,
Yeah.
and this is not sustainable, and this is not great. So I was really glad when kind of things turned around. It's kind of an interesting thing because people in real estate are like, oh, I hate it when interest rates going up, and I was like, yeah, but we were too low,
We were.
and it was it was causing problems.
Yeah.
And so you don't really want it to go back to 2.75. You kind of do, but you kind of don't.
Well, then you get the backside. Like all the complaints we have right now, honestly, can be tied
yeah.
back to the fact we had those rates.
Absolutely.
And what would we all ultimately have loved looking back? Just 5% the whole time. Just more
Yes.
predictable, reliable.
That's what I was going to say.
You know?
Well, and back then I was also telling my investors, I said, look, you're never going to get these rates again. Like, I mean, ever. Like, there's even a greater chance of you getting a 2.75 on a primary
Yes.
than investors getting or a
heavens.
second home rate
no,
because that's just, it's not sustainable.
No chance.
And I think that we've gotten smarter about that.
Yeah.
And hopefully we've learned that mistake and we don't go back there either, because there does need to be, and I explain this to people when they call me and they say, hey, I want to buy an investment property. And I explain, you are going to take a hit on the interest rate. And it's actually a good thing
It is.
because we want people to get into their primary homes.
Yeah.
We want, and we also, I mean, if you are lending or if you're borrowing, for something that's maybe a little more risky or something, then you're going to have to pay a premium,
For
like
sure.
with anything.
Yeah.
And so, it does come at a price. And so it's not, people sometimes get these misconceptions and they'll think, oh, I'm going to find a rate out there that's, 3% again or whatever for an investment property. And I'm like, good luck.
Yeah.
Because it's just not going to happen,
It's not for sure. And like you said, it's good that it doesn't, right? I think investors play a critical role in helping people have properties to live in. So there was a study done, I think 6 months ago or something like that, where it talked about that 85% of renters in Salt Lake County cannot afford to buy a home, which is brutal, right? Like I think affordability in Utah is one of the biggest topics that we talk about, right? Really unfortunate for those 85%. Let's be very clear, right?
Oh, very clear.
But they have to live somewhere, ultimately. So if an investor can come in and fill that spot, and that's the thing, even with rates going up, it still makes sense to own investment properties, right? Because people still need to live in homes. Like it's just life.
And I've rented. Like,
Yes.
I mean, I sold a house about 2 years ago and there was a gap.
Yeah,
so,
absolutely.
And there's always a need for rentals.
Always.
And like to your point, a lot of the renters, they can't afford to buy right now. And so there are some other programs. And I thought maybe we could talk about even the kind of the first time home buyer program. And what's interesting on that one is I was actually part of the discussion up front because a lot of people know I'm involved in politics. I've been involved in politics for years. That bill kind of morphed several times. And what we ended up getting different than and it's still great. I'd like to see a few little tweaks done to that bill. In fact, I might be up to something. I might be up to something on that. But
follow the podcast for the latest news.
Yes,
all right. So.
Yes, but I'd like to see some of that expanded and changed a little bit. But I'd like you to maybe explain kind of that because I get questions about the first time home buyer grant and tell us a little bit about that.
We get questions all the time too, and a lot of misconceptions as well, right?
Yes.
So one thing I do want to say is while the grant, and we're going to call it assistance, actually. We'll come back to it.
And I kind of call it a loan because it's not a total grant.
It is.
But
it's just not a grant ultimately. And if you actually look at the state's website, it is called assistance. So we kind of try to go to that terminology now. The cool thing about it, though, is they originally set up 2,500 first-time home owners could qualify for it at $20,000 a piece. So it's $50 million put aside, right? And it was really slow in the beginning because you can actually watch online how many were being used. It's very slow. But the pace has picked up immensely. So I don't have the most accurate number in front of me. But when I looked like a week ago, there were only like 600 left. So that means in the last year, we've used almost 2,000, which is so cool. Like Yeah, there's some stuff I'd love to change
Yes.
on it too, don't get me wrong. But man, we put like 2,000 first-time homeowners into homes with that program.
And
Like,
that's what I was going to say.
incredible.
And I think it was definitely, it's a huge improvement.
Huge improvement.
Don't take me
Yes,
wrong, but I'd love to see like some other little things
for
happen,
sure.
or an extension as well.
Yeah.
And kind of to jump in on your point there, when there's only a certain number available, if somebody is doing, it's basically when their application goes in, or how do
You
they
can
know?
reserve one
You
in
can
advance.
reserve it.
Yep, you
That's
can
what I was
reserve
going
one
to
in
ask.
advance. Because a
Okay.
lot of it, like we talked about new home construction, okay?
Yes.
So a lot of that, Utah has this incredible blessing right now where we actually don't have inventory, right? Like if you're a new
Right.
home builder right now, you're really not sitting on many homes,
No.
especially at affordable price points. So you are having someone come in, put a deposit down, and move in 3 to 6 months. So yes, you can reserve that, right? Because if you want to talk about nerves of being a first-time home buyer, you reserve a
Yes.
home and don't know if you can get your down payment in 6 months, like no, the state looked ahead, which is
Yes.
fantastic. So the state offers two programs, okay? So there is the one you've seen more in the news lately, which is that $20,000 we're going to call assistance, all
Which I
right?
like that
Yep.
better.
To buy a home, all right? So the home needs to be a new construction, not previously lived in. Needs to be under a $450,000 price point. And once again, we are filming this November 7th of 2024. That might change in the future.
I was going to ask about that. Okay,
Has not
so
changed
it's
yet.
450
$450,000
for now. It like, okay, and not to get into the minuscule, but
Go
this
for it.
is when a lot of people also get, they ask me these type of questions. So let's say that they go to the design center, because this is on a new build, right? And does it only qualify for new builds?
Only new builds.
And that's what it's important to
Yep.
to note on that. But it's on a new build. They go to the design center. Let's say that their base price is 440, and they decide that they want to upgrade, and they found things, and it gets it to 460. Can they pay that 10,000 to get it down, or does it have to be
Purchase price contract.
purchase price on contract? Everything. Okay.
So here's the workaround, and a lot of builders are already doing this, right?
Yes.
And I don't even say this workarounds even makes it sound bad.
yeah,
Like this is just the way
yes.
you do it, okay? Most builders right now are providing some kind of incentive towards closing costs or whatever you
Exactly.
want to do.
Yes.
So you're 460, like you said, okay? Let's take.
I just looked at one
Yep.
last night with somebody. And
There
that's
you go,
why.
right?
Well, because their base price is going to be probably at 440.
Okay. Yep. And you only have 10,000 to
And
work
so we're,
with.
yeah, and 10,000, it sounds like a lot if you're a first time home buyer,
It's
but
not.
it goes really quickly.
That's your floor.
Yeah,
So-
exactly. I was like, oh, you want some, flooring?
Yep.
Okay,
Gonna cost
well,
you 10
then,
grand.
yeah,
Yep.
doorknobs. No, I'm just kidding. You
Yeah.
really do get doorknobs, but it seems like it sometimes.
Yeah.
Maybe actually not pulls on
No,
your
yeah,
cabinets.
exactly. If you're-
Don't just strip those
Bring
off.
your own doorknobs, all
Yeah,
right?
exactly. Do
So,
those later.
But yeah, let's say it's 460, like you
Okay.
said, okay? And the builder gives, let's say, 3% of the purchase
Yeah, because that's
price.
what they're going to do.
Pretty normal,
right?
right?
Yes.
Well, then take 10,000 of that 3% and have the net purchase price be 450 with whatever the remainder of that incentive is, all right? Well, then the question becomes, well, wait a second. Okay, I have my purchase price of 450, but I
Yes.
don't have money towards closing costs, right?
Right.
Well, that's the $20,000 grant, which will come, or assistance, sorry, which will
Yes.
come in and help with the down payment and then also help with your closing costs as well.
Perfect.
And that's kind of the way you do it. And I'm so glad you brought that up. And most builders are aware of this. And so if you let your,
But I've had people that be confused on it, which is interesting,
Oh,
because
yeah.
I've actually talked to some builders that are a little clear, but I would say actually quite a few of them are
Really?
not
Okay, yeah.
as much. And
yeah.
and it's interesting because there aren't a lot of projects, depending on what county you're in, that even qualify for that.
That's why they
that
want to
price.
raise the price point,
Yes.
especially like you said, county. I love that you said that. We do have different levels.
Yes.
By the way, it qualifies single family, townhome, condo, all those.
All of those qualify.
All those qualify.
And I love that we're going into this detail, because these are the things that, people can read a little bit online, but they don't know. And when they actually get in a situation with it, they're like, okay, but
Does this one?
does this exact thing work?
Yes,
you know?
absolutely. Yeah. So they do, right?
Okay.
But then to your point, a condo in one county or a home in another county, very
Well,
different.
condo and house.
Yeah, right? Like
same price.
So
right.
you've got that, okay? The cool thing about that program, all right, is you do not have to make a payment on it while you own the home, all right? You only have to make a payment on it when
Absolutely.
you sell the home or you refinance the home, all right? And then there has to be a payback of this assistance, okay? So once again, that's where I love to use the word loan. It is a loan. You pay it back, okay? Now, there are some ways that part of it can be forgiven. I won't get super into that. It kind of becomes a case-by-case thing and how the market's doing down the road. But for all
Right.
intents and purposes, it's a loan with no payments.
Exactly.
Okay, so we love that. We've got that option.
Yeah.
Okay, the other option we have is the one we've had forever. It's the less talked about option, I guess, which is where the state will give you up to 6% of the purchase price of the home to use towards your down payment and closing costs. Okay, it is county specific based upon loan limits, loan types, but let's just use 6% for like really easy math. Okay, so you can come in, you have 6%. You can use like 3.5% towards your down payment, 2.5% towards closing costs, plus the builder is going to give you some money. Plus, you can use this on an existing home too.
And see, that's the key because
That's the biggest
people
piece.
don't know that there is a program out
There
there
is, yes.
that you can use this for.
Yeah. There was a lot of conversation when the $20,000 one came out. They're like, oh, they're going to do one for existing homes too.
Well, because
It's like,
originally it was actually going to be for both.
it was, right?
And then they ended up putting it for new construction.
Which,
yeah,
once again,
it's
trying to manage
understandable.
inventory, right? Like we're trying to incentivize builders to build at affordable price points.
Yes.
Great, right? But we still have this other program. So I know
Exactly.
the 20,000 didn't come across, but we have this other program. Biggest difference, like you said, existing inventory, you can use it on, and then you do make a payment on this mortgage while you're paying it back, all right? So once again, that is a loan. I don't even call it assistance. It's a loan. But you can come in truly and buy a home with zero out of pocket. And like, I know that sounds like clickbaity, but you've seen it.
Well, I've
like,
seen it, and I've actually had a client that did it, and I don't have very many clients that do it, but it is possible.
Yeah.
And they came in with basically almost nothing down, and
truly.
I mean, and I even was like, okay, because I do a like first time home buyer, I do kind of all the markets, but
Yeah,
I
you're
also
full
do a lot
spectrum.
in luxury.
Yeah.
So it's actually a lot of my clients that their kids are
Very
now
cool.
buying.
Yeah, I love
So it's
that.
like all of a sudden I'm like, oh, okay, we're jumping over into this arena. And but there's so many little things out there, but they, and they hear things. But like you said, there still is something out there for existing inventory.
Absolutely.
And that's what I want to get across because new homes, and I sell a lot of new construction. I actually do about, I'd say a quarter of what I do is new construction.
That's why those builders love you.
And so,
right?
yes, so I do a lot of new construction. And there's reasons for that too, and especially with the kind of first time buyers too,
absolutely.
because a lot of times they're like, "Wait, I don't want to repair a water heater.
Oh,
What's a
for
water
sure.
heater?"
Oh.
So
If you've got no money to get into a home and then a bill pops up a month later,
that's why
tough.
I do recommend it's like that's another show, by the way, for another day. Why not to buy a fixer upper if you're a first time home buyer? Because literally,
But I want to go on an adventure, Heather. Okay? So-
first time home buyers should really try to not buy like big fixer uppers because the unknown costs are what kill you. So getting back to loans though, there are programs out there, and I think that's what's important to know. And what kind of percentage rate are just roughly? Can you even share
for sure
with that amount of money?
So
that
the cool thing
borrowing?
about the Utah housing programs, right? These are government-backed programs, so they control the interest rates, which is really cool because it allows like any lender to offer the same program, right? Like you as a consumer and you as an agent, you feel confident, like, hey, this is the rate. We can log in right now. We can all see it. Okay.
Right.
So the rates today are probably somewhere between a 6.375 and a 7.375, depending on the program. And the other cool thing about that is those rates are actually pretty good compared to, like, once again, November 7th, whatever rates are today. You're not paying a penalty for this rate.
Right.
The state has set up this program. It is obviously funded by taxpayer dollars. Then you pay back into it. So it's this.
It's kind of a perpetual.
Perpetual is the exact word. Yeah, it's
kind
perpetual
of
sum.
growth account.
Yeah. So rates are good. Closing costs are relatively low on it. Like it really is a great program.
And when
it's
I've
hard.
closed one of those, it actually went more smooth than because I know back in the olden days, because I've been in this a little bit of time, and sometimes it would take extra months. Like we're talking 2 months extra.
Wild.
Like it was crazy. And we would have to be making a lot of phone calls and calling. And kind of having seen these now go forward, it really was not too different than a conventional loan. I mean, there's different pros and cons to going both routes. But really, even with the percentage rate and for coming in, because it is more risky, for the banks and for people to, have somebody come in, buy a house with no money down.
Yeah.
So, typically there's a bigger fee or a penalty with that.
Typically, and on this, there really isn't, is the nice part.
Yeah,
right?
that's what I was
Like,
really surprised at.
It's great. I think the state is truly trying to help out where they can. Once again, back to affordable housing. I mean, you've spent your time in politics.
Yes.
It has just been a constant piece of conversation, probably for like the last 10 years in Utah. We were a really affordable state
for sure.
when we were both younger,
Yes.
right? But now, I mean, we're second or third most expensive state in the country, which is just insane if you think about like we're Utah, right?
Right. And I do mention this often, but even I saw a shift in my clientele during COVID. It was kind of like all of a sudden Utah was on the map.
Yep,
absolutely. And I had people calling and saying, hey, I'm looking for a state with, kind of lower taxes. So a lot of times seniors that are moving out of California
Yeah, we have great
or
income
like
tax.
East and West Coast. And they're like, or they have kids or grandkids out here. So there's kind of this family draw. Our tech sector and, is just booming. Our manufacturing, people don't talk about this, but even our manufacturing in the state of Utah has really come back around. I mean, we're starting to do some really amazing things. So it's, we kind of want this balanced ecosystem and economy economy, or it just doesn't work. So you're watching in some of these other states where, at least this is what I'm doing,
Hmm.
there's some big spikes,
Yeah.
but sometimes they don't have the infrastructure to really back up kind of that long-term growth.
Yeah.
And that's one reason I am kind of bullish, I would say,
Yeah.
on Utah, because there are factors here that show the stability.
Absolutely.
And that we're not kind of just a flash in the pan.
Yeah.
So anyway, of course, I have a lot of Utah pride, and I can go on
Not
about
a paid
that.
product placement, but we love Utah, right? So
Yes. Well, and so let's talk about, because the Fed is meeting today, and kind of just some general
Yeah.
ideas on this. Because one question I've been getting lately is people said, but wait, they've announced interest rate cuts, and now they're back up.
Yeah,
So
for sure.
what happened and why? And how does that work? Because it's, people can they can announce the cut, but it doesn't totally trickle
Oh, for sure.
or
Yeah.
end up that way.
So, I mean,
feel like it's the Plinko. Have you guys remember what the Plinko machine, do you, okay, I'm going to date myself. This is like Price is Right, okay?
Oh, yeah, okay. Yeah, where you
Price is
drop the
Right, and it's
things,
like,
yeah,
so I feel like
yeah.
it's like, they choose something
just
and
don't
they're
know where it's
like,
gonna land.
hey,
Yeah.
we're going to say that rates are cut, and then they drop it, and it's like, but you don't know where it's going to land.
For
right?
sure.
So anyway, I'm just calling it the Plinko rate.
No, absolutely. So, I mean, let's talk about this. So the last federal meeting was on September 16th, I think, and they cut them 50 basis points, right? So that was the first cut in like 4 years. And also, you can cut them only 25 basis points.
And say that again, because that was a big deal.
First cut in like 4 years.
Yes.
Okay. I mean, wild, right? And it wasn't just 25 basis points, it was 50. Okay. So like we should have really seen the market move. All right. But here's the thing. If you go back to like 4 months before September 16th, okay, and you watch where interest rates were to where they got the day of the meeting, interest rates came down, mortgage rates, by the way, okay, came down almost 1.5%. All right. So almost 150 basis points. And then the Fed's only cut rates 50 basis points, which was totally expected, right?
Yes.
What has happened since then? We've seen mortgage rates just go back up, right? And once again, it's a roller coaster. Like if you're listening to this 30 days from now, they could be all the way back down. Who knows? But we've seen them go back up.
But we're going to see this pattern. I mean, and the reason I like talking about it is because it's a pattern.
It is for sure. It's not a predictable pattern.
No. Like I said, Plinko.
Yeah, exactly. I love the Plinko thing. So what it is ultimately is mortgage rates are dictated more on bonds, all right? So a lot of people will ask me, like, how can I watch mortgage rates, all right? If you go watch the 10-year Treasury yield, it will follow somewhat what mortgage rates do. And the crazy thing about mortgage rates is they're actively traded. Mortgage bonds are actively traded. So that's why they can reprice every few days or every few hours, where the federal fund rate only changes once a year, twice a year, something like that, right? Federal fund rate affects credit cards. It affects a lot of like HELOCs, commercial rates, that kind of thing. But it doesn't directly correlate with mortgages. Mortgages are more tied to long-term beliefs of the economy. All right. So we're talking about inflation. We're talking about jobs, that kind of thing. So
how people are feeling, kind of like what their outlook.
This sounds nuts, but it's emotional.
Yes.
It's very emotional, right?
Yes.
Like, once again, not to get political here, right? But we've had a lot of jobs reports released this year. Okay.
Yes. And editing of job reports.
And editing, right? And here's the crazy part is those job reports come out and mortgage rates just start dancing that day. Okay.
Yes.
But then a month later, the next one comes out and we revise the one from a month ago. And mortgage rates don't move off the revision, right? It's this very emotional response to the market, right?
Which is a reaction, for sure.
It's so reactionary, and it's very different than it used to be, right?
That's what I was going to say. It's very much changed. That's why, like, even in the time that when I did mortgage origination back in, and like I said, this is like back in 2004, okay, so like 20 years ago.
Okay.
But like, it's so different.
So different.
And that's one reason, like, even I answer kind of some basic questions with my clients, but then that's why I call you, because I'm like, you know what? It is very different and things have changed. So kind of going back. Okay.
No, absolutely. So like today, they're most likely going to cut rates 25 basis points, right? Mortgage rates will not change today at all because mortgage rates are actively traded bonds. So the Feds have been talking about this rate cut since the last meeting, all right? So the market's already priced it in, all right? Now what will happen is Jerome Powell and the governors will come out and they will talk about what it is going to be going forward. So if something unexpected comes up in that conversation, we could see rates move, right? Because once again, we're trading off of the rumors instead of the news or whatever, right? But then we also have a jobs report that's coming out this week, and that jobs report will have more impact than the federal rate cut will. So it's like in our mind, it's so disconnected, but just look at it that way. The federal fund rate is much slower.
I love that because it is really, it's the jobs report
huge.
That is
Unemployment
so
is
weighty.
the number one impactor on mortgage rates right now, at least the last few years too, has been unemployment. That's it. If you want to track the two, track unemployment. That's it, right? Because
I love that.
unemployment speaks to long-term stability. It speaks to inflation. It speaks to all these things. The Feds are pretty close to their target of inflation of about 2%. Unemployment's gone up a little bit. If they can balance these two for the next year or so, we'll see mortgage rates calm. They're not going back to the twos like you brought up. No way, right?
Yeah. Even with the political change or anything that's happening, it was interesting because I was in a meeting with somebody that I pretty much respect. Well, it's Gary Keller, and he said, plan for the next year. Like, we're not going to see a lot of huge swings. We're going to see some things and talk about things,
Yeah.
and rates are going to, announcements are going to happen. And like you said, kind of that emotional part, I think
Yes,
is going
tons
to,
of that.
it possibly could change.
Yep.
And I think it is changing with certain people. But also at the same time, I think we do need to be careful so that we're not back in the same situation we were in a few years ago, where all of a sudden we're having to just, just interest rates just soared,
Yeah, for sure.
literally overnight.
They did.
I mean,
Oh, it
we
was
had
incredible.
people that then just didn't qualify,
Yeah.
for the home, or,
Yeah.
there were some, it was kind of I call it, it's kind of like whiplash, right?
Yeah.
And people were moving forward. And I feel like this year even has been a lot of whiplash in a lot of ways, because people have been like anticipating. So they're like leaning in and waiting for something to happen. And then they're like, okay, wait, not much happened.
No, for sure.
A little, or I call them little blips.
Yeah.
Because I have noticed that there are little times where all of a sudden when the rates dip, I'm like, hey, we're putting you on a contract right now.
Oh, you like almost have to.
Yeah. I mean, and so we kind of watch these little blips.
Well, let's talk about something that we haven't talked about, okay?
Yes.
And what this is your pre-approval. Let's go back to that for a second, all right? And how interest rates change and how it affects it, right? Because I think a lot of people don't understand this either.
So important. Okay? Yes, I love that you're going to talk about
Perfect.
this.
So you get pre-approved. Congratulations. Today's rate's 7%. This is how much you qualify for. You're like, awesome, right? Well, the next week rates are 6.5%, all right? Well, I'll call you and I will say, great, you now qualify for this much, all right? But also remember, rates could go to 7.5% that way. So you could actually get approved for less. So a lot of people ask, can I lock my rate? Or I guess, when can I lock my rate? Okay. So lenders do offer the option to lock your rate without an address on your property. Okay. So you can go in and basically lock it.
Repeat that again,
okay?
Because this is a question I do get. Okay. Say
time,
that
okay?
again.
You can lock your rate without having an actual address. It's called a TBD, a shop and lock, something like that. All right.
And some people go, what?
Yeah,
and
it's wild.
they say, okay, that sounds scary. Okay, it's really not as scary as that sounds.
It's not as scary, but what you have to remember is it has the same upside as it has downside.
That's what I was going to say. There's risk involved.
Risk involved both ways, right? It's just like gambling, and now you're just buying a bet, right? Because if rates go down, well, you've locked your rate. Like, you're taking that rate, and you can obviously focus on a refinance down the road. But if rates go up, oh my heck, you're hedged, right? It's incredible.
Yeah. Well,
right?
and then people they're like, they don't love it, but
yeah, it's something you can do.
It's
right?
just one of those things.
It is, right? You can't do that on Utah housing, by the way, so that's something to be aware of.
Yep, good point.
A lot of these things we talk about can't necessarily be combined. So
and that's what's interesting. And that's why it's so important to have a good lender. And I'm going to plug John again, because what also is important is that sometimes people don't understand that there are different programs out there.
So many.
They just think it's just like one way. It was kind of like back in the day when my parents got a mortgage. It was, okay, they went to a bank, they signed, it was 17%, by the way, 17,
a little higher than today.
A little higher,
Yep.
So a very different system, you know, and now like when you're saying we can lock rates in advance without even a complete like tax ID number, or
sure.
property address,
It's wild,
It's
right?
pretty wild,
yeah. So then like traditionally, I guess what you would do is you would lock your rate when you go under contract, okay?
Right.
So there's the concept of floating or locking your rate. So let's say you're under contract now, okay? Floating your rate would say, hey, I'm not going to lock my rate. I'm going to wait and see what the market does. This is a fantastic idea when we think rates are headed down, obviously, all right? So back to COVID days, a lot of people, like in the beginning, they just floated their rates because if they waited a week, rates were that much lower. Like it just kept going down.
That is wild because I remember this.
It was great, for the time it was, right?
It was kind of glory days for some of us.
It was like, it was Disneyland until Disneyland closed abruptly, all right? So I went out of business,
the rain
all right?
came.
Yes, the rain. The
and the flooding.
Yes, not fun. So then you've got the idea of floating, and then you've got the idea of locking, right?
Right.
And locking is where you just lock in the rate, right? And here's what my advice is to people all the time on that, okay? Talk to your lender about if rates go up 0.5% or they go down 0.5%, and look at that spread. Can you afford the payment if rates go up 0.5%?
Yes, exactly.
Float, whatever.
Right.
You can handle it, right? But if you can't, and that will break you on the deal, lock it. And maybe you didn't lock it the perfect time. I promise you, you can't predict it. I can't predict it. You can't predict it.
I can't predict it.
Just deal with it.
But if you know you qualify, this is the
Yes,
big key.
then just do
If
it.
you're qualified and you know that this is, what you're moving forward with, you're in it, you know that you're going to be signing on a property within 30 days.
Yes.
I think for me, I say, you know what? It is good to just have that, because if it's tight at all, and that's one of the other things I like to just find
Yeah.
out, because and I am a kind of going back to even investor side. I'm a conservative investor. Like
Yeah.
I'm not one of those that's like, hey, go and triple mortgage your house and
Yep.
do whatever,
For sure.
and go buy another property. I like to really look through things like with my clients and say, okay, does this make sense for
Yeah.
you? And one of the kind of going back to even first time home buyers, what people don't realize is that they tend to only look at rent, and they go, oh, but it's only costing me $1,500 a month to rent right now, or $1,800 or whatever
Yeah.
it is. And then they go, that's not much money per year. What they're not considering, and I stress this a lot, is that go look at inflation. Go look at like you're not just throwing your money away, but then you've also got inflation. You're missing out on the equity jumps in the market. And so there are negative things. It's not about your $1,500 more a month. It's a lot of other factors around that.
Yeah.
And so a lot of times I tell them, I'm like, you're going to be looking in a different neighborhood or a different area. You're going to maybe have to go further out from your job, and commute more if you're not in something. So even it's better, even if you're just, get into it, people think, oh, I need to get into my dream home. I want to get into my dream home. I'm like, well, first of all, my first home was maybe 1,300 square feet. I was tiny. I had a 1,300 square foot home, $100,000, by the way, but I know like, you can be jealous on that. I'm actually a little sad that I didn't keep it as a rental, but
great.
But and I remember still those nerves, and I think that's why I like to help first time home buyers, because I still remember, feeling all the anxiety around that.
Isn't it funny, the older you've gotten, and obviously you've had the opportunity to buy some additional homes, that it never stops feeling a little nervous. Like I tell clients all the time, I'm like, I promise you, regardless of what house I buy, regardless of the house payment, I'm going to be nervous.
I'm always nervous.
Always nervous. I'm always like,
I just closed on an investment property a few weeks ago, and I was like, I'm doing this again. What am I doing?
For sure.
But ask if I regret any of those.
No, you don't, right?
No.
And
nobody regrets getting into the market. That's what I
don't.
tell people. I go, you know what? And even, okay, maybe you'd cut out your DoorDash and your Starbucks or something. But in the end, it is so important that you're there, because this is the best investment you can make for yourself. So I think kind of we have only a few minutes left, but one of the things that I kind of want to talk about maybe just at the end is that I don't know anybody that ever says, gee, I regret getting into the housing market.
Yeah.
Do you ever get that?
No, let me give you my insights on this, right?
Yes.
Because I get asked all the time. So it's funny, people come and talk to you as a realtor.
As a realtor,
You're
right.
going to provide this incredible opportunity for them to buy a home, right? But they always think you're biased towards just buying a home, right? Because
absolutely.
Let's be clear, everybody on this podcast, on this side, that is how we support our families, right?
Right.
So sometimes all people then ask me, right?
Yes,
like, hey,
absolutely.
I know Heather said I should buy a house, John.
But what do you think?
What do you think, right? And here's what I always tell people, okay? For me, and this is just my opinion, it comes down to how long you think you want to own the house for, okay?
Yes.
So let's talk, for example, let's say in 2008, you bought a home at the peak of the market. Like, congratulations, you had the worst timing in history, all right?
Yes.
2009 came around and you looked like an idiot, right?
Yeah.
All your friends and family like, you're so dumb, you bought it at the wrong time.
Right.
So yeah, if you tried to sell in 2009, you were in real trouble, right? You might have lost $100,000.
You probably lost money.
Right? But what, 4 or 5 years later, 2012, 2013, those people were even. And then you go to now, it's like, would you go back and buy every home you could at the 2008 peak?
Absolutely.
100 of them, right?
Yes.
These
it's actually
times
one of my
so-
biggest regrets.
There you go.
I did buy, I joke around and say I'm going to do some little Netflix documentary. There's that Big Short one out there. And I'm like, I was that stay-at-home mom kind of that was doing like mortgages on the side, a little bit mortgage origination. I had actually pulled out my equity from my home, knowing that kind of the market was probably going to crash.
So you want to protect it.
And I pulled it out, put it in the bank, sold my house. And then basically we looked, and then we bought something at the very bottom of the market, like crazy pricing, and did really well on that house, which eventually helped me buy some and get into investor world.
Yeah.
And so best decision ever.
Decision, right?
But I will say, even the people that bought at the top right now, they've still now made more money.
Oh, they look so smart.
So it's kind of like the stock market is what I tell people. It's when you buy and sell, and you can't predict.
No.
So just buy, sit in it, get something that at the time is a great deal,
Yeah, you can
right?
afford it.
And that you can
Yep.
afford it, and then give it time. So
Yeah,
then real estate's always a great investment over time, is what I
it
say.
is for sure.
No, and that's historically proven. I mean, you
Yeah.
can go look at the charts, and and I don't have any regrets. In fact, I'm like, oh, we should have even bought every last thing we could have,
For sure. Anybody that
So
wanted to could go back to 2008 right now. They'd buy every home they could,
and they
right?
say that,
Yeah,
like, I'll
for
be at a
sure.
conference with,
Hmm.
and they'll raise their hands. They'll say, who wish they would have bought more
Yeah,
back
for
then? And
sure.
it's like every hand,
So
right?
yeah,
And so in time, and I think it's important to point that out, because if you want to be in home ownership, or you want to really kind of, start your investing, because I feel it's a very necessary part of your portfolio.
yeah,
And so get into real estate, give it some time, don't let the rates dictate whether you're buying. It's what you're buying and selling right now.
yeah,
So there's always great deals in every market. I tell people this all the time. There's great deals in every market.
yeah,
Even when we've been at multiple offer, when it's been dead, whatever it's, whatever conditions, you just need to have a very savvy team, realtor, lender, and I feel like we could have this, you know, like a duet, like a Frank Sinatra,
I don't know. I
little.
think they want the podcast, but not the duet from us. All right.
Okay,
So
maybe not the
we'll,
singing.
we'll use our
We'll
strengths. All
cut
right.
that out.
So
That's
yeah.
true.
Okay.
But at least, like, I mean, it's like it's like a team.
It is. It is.
And
Yeah.
you really need a good team behind you to know what you should buy also, because a lot of times I get clients, in fact, I've got one right now, that they're like, but this is, what we've seen
Hmm.
HGTV, we want to, like, do some fixer uppers. It sounds like I'm ripping on fixer uppers, but I don't mean to be,
Hey, come
because
on,
I've
Chip
done
and
a
Joe are
lot of
really
those.
nice.
I've
All
done a lot of
right.
those,
Come on.
but you have to be careful,
Hmm.
because you've got to know your costs. And so fixer uppers can be great. You can make a lot of money with
Yeah.
fixer uppers, but you can also lose a lot of money with a fixer upper.
Absolutely.
So a lot of times it's knowing what to buy,
Yeah.
and again, not letting the rate itself,
Yeah.
dictate it,
Well, I think and I think the parting thing that I would say, because I know we do have to wrap up, is this, right? Is like, let's go back to this nervous word. That's kind of what we started
Yeah,
with. Let's kind
I
of end
love
with this,
it.
okay? Is like, it's always nerve wracking to buy a home, right? So I've got clients right now that are like, I'm gonna wait for rates to come down, and I'm like, totally, like I totally get it, right? But do you remember the last time rates came down, home prices went up,
And you were
okay,
at multiple offer,
and multiple offers,
and you were
so
paying extra.
and you didn't buy then, right? And
Right.
then people are like, well, I'm going to wait for them to really come down. And I'm like, here's the thing. I think if rates go down really, really low again, we're going to be in a bad position. We'll have high unemployment. So
That's
are
right.
you going to go buy a home while your job's at risk, right? So why I bring that up is, yes, you can absolutely get lucky. And people love to bring up the fringe stories. Like, well, this person bought this house and they're $200,000 upside down. For sure they are. It happens.
Hmm.
There's also the guy that bought the house and made $200,000 worth of equity while it was being built. For sure. But these are the extremities. Okay.
Absolutely.
Let's just focus on like reality here for a second,
Right.
right? It will always be nervous times to buy a house. There will always be a reason to and a reason not to. So like you said,
Yes.
you buy long term, you buy with the right team, you'll be fine.
You'll be fine. I love that. Okay,
Yeah.
in closing, what is the, like, one last thing that you would wish that everybody would know? Like that, like, maybe the question I should ask you.
I would say the biggest thing would be to start looking into this before you're ready to buy a house.
I love that.
There are so many TikTok things and misnomers and things your parents didn't tell you and your grandparents didn't tell you, and the world's different. You're probably scaring yourself away from buying, or trying to rush into buying when you shouldn't,
I
right?
love that.
Like,
Yes.
just get educated early. We don't teach this in schools, which is insane. I mean, real estate's a
Oh,
multi-trillion-dollar market, and we don't have just a class in school of like, hey, here's what you should look for, Just go get
on
yourself
that
educated.
tangent, we actually did, when I was on the state school
Mhm.
board, I said we need to add into there's like a financial literacy
Mhm.
course that's required.
Love that.
And I said, they touch on like stocks and bonds, and I said we have to talk about real estate.
Yeah.
And
Yes.
I would still love to see that be incorporated more, because I think people in high school, even, they've got to learn, right? And
Yeah.
just, home ownership is important. And so I love that. And I get that question a lot too, because people say, well, when do I talk to a lender? And I say, right now.
That's right now.
Like, I right now, like, get a plan.
Mhm.
If nothing else, I mean, and John's been great about this. He can just even help put a plan together. If you're not qualified now,
Yeah, we don't have
that's
to
okay.
pre right now.
There's
It's all
not,
good.
like, I
Yeah.
think people out there, they think there's all this pressure. And what's
Yeah.
really kind of interesting is, I know since we've worked
Mhm.
together quite a bit, I don't pressure anybody into buying a home. I'm not one of those that's like, you have to buy this
No,
house.
for sure.
It has to be right. But I do want to help calm the nerves
Yes.
and
Mhm.
and give you data that's important. And I know that's what John wants to do, is
Absolutely.
to give you important data so that you can make a great decision. and it can be the right thing. But I think it's important to know that it's never too early to talk to a lender.
No.
And, and like I
Or
said, get a
an agent.
plan,
Yeah. Okay.
So
Let's get you in some high school classrooms, all
I
right? Hey, if
know.
you're
Let's
listening to
do
this
it.
and you're a teacher, get Heather to come talk to your class, all
Hey,
right?
I love it.
There
Let's
you
do
go.
it.
So,
Well, good. Well, thanks for joining today. And thanks so much, John,
thank you, Heather, so much for having me.
for
Thank you for
coming
your
on.
team. So,
Okay. Well, thanks so much.
thank you all.
See you next week.